The second section of this chapter is about capital budgeting. This is basically companies trying to decide whether or not they should use big chunks of money to invest in some major investment. Um, there are a few different methods of evaluating an investment that the book is going to get into, and we're going to talk about them right now. Study Objective 9 deals with the first two methods. Actually, all three methods. The last method is generally going to be perceived to be the best, but you're going to have to understand how to work through each of these methods in determining whether or not an investment is a good idea. So the annual rate of return method basically is just trying to figure out what kind of a profit rate, essentially, would we earn on an investment if we went ahead and bought it. So what you do to figure out the annual rate of return for an investment is try and figure out what you expect the annual net income from that investment to be. If you're just putting money in a bank, then whatever that interest you'd earn, that would be the income. So if you want to buy some big piece of machinery, you'd have to figure out how much income do you expect to get from using that piece of machinery or offering it to customers. So what's the expected annual income, and you divide that by the average investment. The average investment is basically there's a formula right here to figure that out. What did the investment cost you? What is the value of that investment at the end of its useful life? You add those amounts together and divide by 2. That gives you the average investment over the whole life of the investment. So you divide the income by that investment amount, and you get the annual rate of return. If that annual rate of return is bigger than what they call a company's cost of capital, then you would go ahead with that investment, or that this method would say go ahead, that it's a valid investment choice. Companies typically will have a cost of capital or a required interest rate for any investment, or required rate of return for any investment before they would go forward with it. So if this particular investment exceeded that minimum percentage, then this methodology would say it's an acceptable investment. The next method is the cash payback method. This method is simply trying to figure out how long it will take a company to get its money back. So you take the cost of the investment and you divide it by its net annual cash flow to figure out a payback period in years typically. So the key here is it says net annual cash flow, not net income. So you have to take net income and add back any non-cash expenses, the most common of which is depreciation expense that might be included in this net income number that you get as part of your problem data. So you add back depreciation expense to get the net cash flow, and then you just divide the cost of the investment by the cash flow per year, and you can see that it takes 5 years to get your money back. If it doesn't work out exactly that way to an exact number of years, you can look at the cash flows. Well, if this is a situation where you have equal cash flows coming back to you every year, that's probably not usually going to be the case. So in cases where the annual cash flows are different, you have to go year by year to see how many years it will take. So if these are your expected cash flows, then by the end of the third year, you'll have 240 back, and the cost of the investment was $300,000. So you need another $60,000 to get up to your $300,000 investment. If $120,000 is your expected cash flow in year 4, it would take you theoretically, half of year 4 to get that extra $60,000. So we say that's half a year, so 3.5 years is your cash payback period. I think I'm going to get into the discounted cash flow method in the next video.